Shantanu Chakrabarti joins us. Let's take our conversation forward. Represents PNB Paribas. Shantanu, good morning. Thank you for joining us. First,
Morning.
numbers from the combined entity. Given that what they've
Right.
already indicated in terms of their analyst day 4 weeks ago and their quarterly update 2 weeks ago, are we in for pretty much an extension of what we know, or there could be some surprise?
I think given the amount of granularity and details they've given out, Nikunja, I mean, this quarter, the number to surprise one way or another too much would be very hard. Because if you think through it, we know exactly what the loan composition looks like at this moment. We know what the deposit composition has been. There have been clear guidances on what operating costs look like. And let's face it, this is not a part of the cycle where credit costs can really move the needle. In any case, it doesn't ever do much for this bank. Whatever little negative surprise there was on non-individual loans of the parents' asset quality was again, in the analyst meet only full clarity was given on that. So, this is not a quarter where the numbers in itself could swing one way or another too much, in our opinion. It's going to be a quarter where the commentary is going to be watched very, very closely as to what is the timelines that they commit in terms of achieving, a certain level of CASA, cost to income, ROA, and margins. And that's what will be key out here, the trajectory and the timelines, not so much the numbers for the quarter. In some sense, the quarter is almost penciled in.
I'm yet to find a bear on HDFC Bank. Even though the stock has no bear, the stock is underperforming. Is it largely
Right.
because of this whole over ownership issue?
I think before attributing a reason, while it is true that at some level most people are bullish on HDFC Bank, once you get into relatives within the prominent parts of the banking sector, which is say the ICICI versus HDFC debate, for example, you'll see two clear camps where one prefers one over the other. Now, people of the opposite camp are not necessarily negative on the other name, but relative outperformance wise, people have very different opinions. Now, from time to time, we have had what the points that you're alluding to, the first we had that issue around MSCI selling, then, the amount that domestics have to sell, and all of these technical factors are in place. But every time I look at the total trading volume of HDFC Bank under the current amount of free float, it is very hard to think that this could be anything more than minor squiggles in the short term. I think at some level, maybe, dwindling amount of foreign flows would have played a role, but we wouldn't want to belabor that point too much. As far as fundamentals are concerned, we think that once we have a situation where that 2% ROA or even a 1.9% ROA achievement is clear in the parts of the market, it's going to re-rate upwards from the valuations it's at. Nicholas, this is a stock which is now at, if you strip out the valuation of the subsidiaries, it's trading at 2.2, 2.3 times 1 year forward core price to book. As you know very well, that's about 40% below where it used to trade. And if ROEs go back to being 17%, right? I mean, it's very hard to see how the stock will not re-rate. And that's why I prefer it as my top pick. It's not that I'm negative on the other two names. It's just that I'm a little more positive here, and this is a little bit more of a re-rating story vis-a-vis the others.
For the first time, we would be looking at HDFC Bank plus subsidiaries. We've always analyzed HDFC Bank for its banking business. How does that change the matrix? Because there are certainly a lot of moving parts now. The AMC business, the insurance business, the securities business was part of it, but largely it's insurance and AMC.
So, I mean, if you look at prior experience of looking at HDFC parent, for example, HDFC parent's valuations actually derated. If you go back in history, from the point in time that the EBLR and before that, the base rate regime went out and you had to do MCLR based lending, which at some level changed the competitive dynamic of the mortgage industry. And especially in a situation where HDFC parent was drawing a lot of fixed cost liabilities, that made it introduced certain asymmetries into their margin profile. So what was earlier a secular margin business to an extent became more cyclical. That's where the derating came in. Before that also they had substantial subsidiaries, but nobody made an argument around holding company discount at that point. It's only when the core business started to derate that a number of alternative narratives seem to have emerged. Similarly, when I look at HDFC Bank's subsidiary set, uh, I don't see a business out there which can make a demand on the excess capital returns that are generated for the core bank. It's not as if there's a weak business out there which needs the financing of the successful bank. So in that scenario, to justify a very large holding company discount, to my mind, is a bit of a stretch argument and probably is influenced by which side of the debate someone stands on. Because the argument around whether similar levels of promoter interest are there across the various subsidiaries, and also in terms of whether the subsidiaries themselves a strain on excess resources. On both of those counts, the fundamental argument doesn't really stand. Can people have a preference for a pure bank play? To an extent, yes. But if that preference goes into any large discount territory, clearly that is arbitrageable.
All right. Shantanu, hi, morning. Also wanted to know what your outlook is on BOB with respect to the halting of customer onboarding. What kind of implications do you believe that this will have in the long haul?
As for the larger PSU banks are concerned, we expect performance to remain fairly steady on the key parameters, which is essentially credit quality as far as margins and as well as growth. And early releases point to that. If I look at the overall system growth number, and if you just do some balancing arithmetic, that also tells you that, especially for prominent large PSU banks, that should be in place. As far as the specific name you are mentioning, it would be hard for me to comment on that because currently it's outside our coverage list.
The view with a lot of banking experts like yours is that the NIMs have peaked out. And there's a report which hit our mailbox on Friday from UBS where they've talked about a downgrade on SBI. Is there merit in assuming that the freebie which PSU banks got largely because of NIM expansion that is over, and then FY25 onwards, the curve of growth is going to be south rather than north?
No, see, two things we have to keep in mind. Overall, the PSU system growth has lagged the private system growth in line with several years of trend. So if I look at, for example, SBI pretty much has been growing at what system credit has been growing at. And I would argue that more of the re-rating has actually come from emerging situation on both credit costs and confidence on extent asset quality, rather than a pure margin play. Because none of the larger PSU banks, frankly, have a very weak liability situation. They are still reasonably high CASA, one of their legacy strengths. So I think the dramatic change in the outlook and prognosis for these banks has been around credit, not around margins. So from here on out, until the credit cycles stays strong and you don't see any event-driven blow-ups in such banks, I think they will, the key narrative around such banks is going to be one of emerging and extant quality of credit. In fact, if you look at the current commentary around these banks also, what are people trying to focus on? They're trying to figure out what is happening in NBFC adjacent segments, what's happening in CVC, MSME, what's happening in unsecured lending. What are those telling us? People are trying to basically figure out if the asset quality can hold. I think that will continue to remain the make or break. Because remember, if in any negative surprise pans out in these cases, you have a high leverage and you'll probably need a capital raise at a valuation situation which is not ideal for you. So we have to keep that outcome in mind.
On that note, we let you go. Appreciate you joining us on ET Now.